Thank you for joining me. I'm Alex, and I want to talk about Caterpillar. So, what they do is construction equipment, more heavy machinery than your standard pickup. Obviously, currently, we're kind of heading toward a global recession, so we'll see how this goes, I suppose. Current price $152, which gives them a market cap of $83 billion. Dividend yield 2.68% with a payout ratio of 55%. And this stock is usually hailed as a dividend stock. So generally people buy the stock for the dividend, not really for growth or value. Revenue $53.8 billion, slightly down. Earnings $6.1 billion, also slightly down, just not significantly. PE of 20 with a forward PE of 21 is a problem, but the current situation kind of precludes making a statement about forward PE, but it's hard to predict things in this kind of market because markets are crazy right now. Total assets $78.5 billion, total liabilities $63.8 billion, which give them a total stockholders' equity of $14.6 billion. All of that is incredibly stable, more stable than I've seen in a long time, and obviously the balance sheet being stable is not a problem at all. So overall, dividend is pretty nice. Growth is negative, and I can tell you trailing 12 months is kind of worse. So they are still making a profit trading 12 months, which is a huge bonus right here. I believe it's over $4 billion. So not really seeing a huge impact. And what I like is that obviously China has been a huge growth market in the past, and they're not really all that affected by the coronavirus to begin with. So overall, I would say that for a growth investor, obviously there's nothing here, especially with the growth being negative in the last year and being negative this year. I would think that they get back to a reasonable amount of growth, but definitely not enough for a growth investor. For a dividend investor, this stock is one of the best dividend stocks there is, mostly because of the ever-increasing dividend and the long-term outlook, more than the current dividend yield, which is not huge. But 2.68% is really not bad compared to the current bond yields, which are, far less than that. For a value investor, the balance sheet doesn't look great. The PE is slightly too high, and the dividend is a nice bonus. The payout ratio is pretty nice. The balance sheet being so stable is obviously a plus for a value investor with a pretty long-term outlook, and so I think that a value investor would do well looking into this stock as well. As far as risk factors go, there are a few competitors, but there's not really a whole lot, and I don't really see new competitors coming onto the market and kind of disrupting the industry. Obviously, electric vehicles are all the rage these days, and they would probably do very well in construction equipment as well. So there's kind of a shift going on right now as well. So that could be a problem in the future, but that would obviously be a problem for everyone else as well. So I don't really see any new risk factors here, and that really would be a consideration for me. So that's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.